Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. So in this video, we wanted to talk about the fact that, we're starting off into an inflationary decade. And a lot of people will say, well, you guys are too doom and gloom because doesn't inflation ultimately make asset prices rise, even the stock market? Well, it's not that simple. So Bob's dug up some great info that you're going to want to see because it's going to explain a lot about how this decade might go. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. All right, Bob. So we've been kind of watching the market here. We've pulled back some, volatility is elevated. A lot of people still thinking that, hey, you can't be too doom and gloomy here. But I think some of the stuff that you've dug up that we're going to show the folks here today is quite interesting, and you'd be foolish to ignore it at the very least.
Yeah, so let's do a working assumption here that inflation is running higher than anybody really wanted to run. Number one. Number two, that it's stickier than anybody thought it was going to be. And number three, the cure that the Federal Reserve is trying to apply to it is ultimately failing. And so we can talk about those things on another day. So assuming that's correct, this is going to be the fourth time in the last 100 years we've had an inflationary decade coming. And so before I get into that chart though, Phil, I want to just show people another reason why that, gloom and doom is a relative term. I'm telling you guys just to get out of tech, all right? And this next chart is going to show you why you don't want to be in high PE stocks or high price to sales stocks, because you now have competition called the bond market, okay? And you have the earnings yield and the Fed funds rate now are flipping. Now, this is ultimately what Powell wanted, Phil.
Right.
He wants to move more money into the fixed income markets, the bond market, and he wants to move people out of the stock market. And so now we've had that crossover. So that's why I wouldn't be surprised in the next 2 or 3 months that we'll get a pause here from the Fed, and he's going to evaluate the earnings yields. Remember, are a function of earnings. So, that number is not static. So the inflationary pressure on companies in terms of wage inflation and also credit contraction and the ability to people simply to afford what you're selling is going to put pressure on earnings. And the fourth thing is that people are refinancing their debt. Coming in March, it's $350 billion of bonds have to be rolled over or satisfied, Phil.
Right.
And they're not going to get rolled over and satisfied at 1.5%.
Oop.
And so there's a problem here. And so what's happening, and I'm naturally doing it too, I'm moving money and more money over to the bond side of my portfolio. I'm taking profit on things that have been moving and moving it into bonds where in 90 days I can earn 4.87%. You're an idiot if you think the way this thing's set up that a new bull market is going to start from here. This is really the last time I'm screaming before you guys go into the class 5 rapids. So let me show you another chart here. What happens during an inflationary decade? So if you see here, we had an inflationary decade, 1910s, 1940s, and 1970s. What happens here is that two ways in which you make money in the stock market, right? Okay, earnings go up or multiples expand. And the next chart I'm going to show you is saying that we've already had the best of the best of the best of the best happening. And right now that tells you that price earnings multiples collapse in an inflationary environment just because the natural state of the chart I showed you before. If people can make money without risk in the bond market, they're not going to try to make the same amount of potential yield in the stock market that is volatile, okay? Now, everybody says, oh, we're in inflation. We have to try to out-earn inflation. Well, there's certain places you can do that, but there's also a thing called return of money as much as return on money. And you get into these environments where you start getting a price-earning multiple collapsing here. I mean, look where they all end up, Phil.
Yeah.
in right here in the low teens,
Hmm.
where we are now, I'll show you in a second, and I'll take a break here and let you kind of jump in on that. But as you can see that the longer it takes Powell to figure this out, the more pressure it's going to be on stock market, and definitely more pressure on companies that aren't making money, high price earnings and high price to sales.
Yeah, this is a telling chart to me because a lot of times, we're always kind of like double checking our work, right? And are we really getting too bearish? Are we going to be really going through a bear market all the way through 2024 as the bond market or the yield curve inversion might be implying? But then you see this PE ratio chart here showing multiple examples of deflation or inflationary decades, because that's exactly what we have on our hands here as we go into the 2020s. And everything is just migrating down towards single digit PEs, which this market is not used to at all. So it kind of lends itself to the theory that this bear market, this market is very used to V reversals out of these bear slumps, right? And it's something I've been telling people too about Bitcoin, where the trough out of this bear market might be a lot flatter for quite a bit longer than people would be expecting. It doesn't mean we can't make money trading or anything like that. It just means that the large V reversals that get us out of trouble quick, I think are largely behind us in the previous decade. And I think we're entering this new era of where it's going to be an inflationary battle. And historically, that doesn't mean, the stock market runs off to the races, because the Fed's now fighting that. And so the tightening, and we may get into that a little later this week on our other video about this tightening may go into turbo mode tightening, because inflation, as was proven out with the last PCE numbers, isn't going away. It's been sticky. So I think it lends itself to, yeah, we need to be cautious, and we need to, not that we're being overly bearish, but it's prudent to just have the frame of mind that this can go on for a lot longer than people are comfortable with or have been used to in the last 10 years.
Yeah, and I think we'll talk about, energy is an area in which will be a bright spot. And
Hmm.
believe it or not, at some point, real estate will be
Hmm.
too, just not commercial.
Right.
And so, so it's everything's timing, guys. It's like, people are just expecting what they saw since 2009, but the Fed's ability to fix it this time is severely constrained. And, we have global forces that work against what the United States wants to do, and we have demographics working against what the Fed wants to do as well. So it's just a really interesting environment. And I want to show everybody what we're going into this inflationary decade where our PE is, just to show you how much we could crash from here. I mean, look,
This
that
is
is
mental.
insane. I don't know if we could say anything more. I mean, look at the PE ratio we're at. It's
Yeah.
it's 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 that much higher than ever.
Yeah.
And look, that has to modify, that has to normalize. And I think the reason why this market's been staying so elevated, Phil, is the whole passive investing schema that came out of the great financial crisis, where
Yep.
a lot of brokers got sued by pursuing, what they thought were good policies for their clients. And every risk manager and every insurance company said, screw that. You can't get sued if you don't lose more money than the next guy. So we're just going to go ahead and we're going to age rate you. We're going to risk rate you, and we're going to buy in these market capitalization rated index funds. And then so we go up together, we go down together, and we leave no room for the regulators or the lawyers to sue us for basically being a whack-a-mole. That works until people start losing money in the stock market, or as they retire and they need to tap in because savings rates are negative now, Phil, people will start selling. And those good guys, those mega cap stocks, they start to bring down everybody, because when they start selling that, you start selling the index. When you start selling the index, everything in the index goes down, no
Mm.
matter how good you are. That's why we always been scratching our head for a while, like, how's that stupid garbage stock going up, in this environment, where they're not really doing well? Well, because they're stuck inside an index. If that index gets bought, they get bought. This is not a 90-day thing here, guys. This is potentially 4, 5, 6 years of just constant pressure on the markets. And people that are kind of hang out to be too bullish in this environment are going to get their heads handed to them. And that's why we've been warning and warning and warning. People haven't seen this
No.
before. Look, it's been 50 years since they've done this. They truncated another economic regulator here, and now we're going to pay the piper, because this should have happened 20 years ago.
No.
Okay, and they didn't let it happen.
Right.
And so now we're dealing with a lot more pain when people are even a lot more volatile. So I mean vulnerable, and things are getting pretty volatile. So I wanted to share that with you guys today. But definitely this week, check in with us because we're going to talk about, Yellen's been fighting the Fed. That's going to go away. We're going to talk about that tightening. Energy is a great opportunity. We're going to show you why. Okay, energy is a great opportunity. And then we're going to just talk a little bit more about what to look for and positioning here going into March because there's some opportunities on the long side, believe it or not.
Yep.
So that's all I got, Phil, before I lose my voice completely.
Okay. Yeah. So I think we're looking still towards 3,900 on the SPX for further pullback, and that 22K level on Bitcoin for further pullback to break through. Once we get through those levels, we'll take a look. But kind of the short term, that's roughly what we're looking at in the markets, just for a quick update on the markets as well. So anyway, guys, thanks for watching. Please hit like and subscribe and smash that notification bell. Set that notification to all, and you'll get notified when we do our daily updates. Other than that, thank you for watching. We'll see you on the next episode. Take care.
Trade Genius.